Ellen, and hi everybody. I hope the second day of the conference is going well into the weekend. We're excited to talk about Finance 101. We have some slides that we're going to go through, but ultimately we're going to leave most of the time towards the end for questions so that we can really get into some of what you all want to talk about. And I think we'll go to the panelists slide, please, Alan. We'll do some introductions. So my name is Megan Shipman, she, her pronouns. I love O4U. I was actually recruited into RBC Capital Markets, which is where I work now, through O4U a few years ago in the class of 2017. Now I'm a senior associate strategist on the global commodity strategy and MENA research team within global research at the bank, which I will talk more about later. Clark?
Thanks, Megan. I'm Clark Anderson, Managing Director at Morgan Stanley, active here for a long time in Pride and the various ways Morgan Stanley participates. This is my first participation, in O4U. Very excited and very interested to hear your questions and hear the discussion.
Hey everyone, my name is Brad Benini. I'm a vice president at JP Morgan. I work in equity capital markets covering the healthcare sector. I started my career in Canada at RBC Capital Markets, which is where Megan works today. I started my career in the oil and gas sector and spent the first 8 years of my career covering energy across North America. I'm a huge fan of Out for Undergrad, and I was not recruited through O4U, and so I think you all have such a wonderful opportunity, and I hope you all take advantage of this weekend and all the connections you make to make the most of this tremendous event. Nice to meet you. Yessie?
Oh, Vanessa? I can go.
Hi. Hey guys, this is Yessie Somoza. No worries at all. I am on multiple headsets trying to make this work. Hi everyone, my name is Yessie Somoza. I'm a first-year associate at Deutsche Bank, where I sit on the FX Risk Management Solutions team within our sales and trading division. I was not recruited by Out for Undergrad, but I was recruited through DB's Diversity Pipeline program, the DB Achieve program. And I'm really excited to do my first panel with O4U, and I can't wait to hear all your questions. Thanks, guys.
Awesome. I will just run through the agenda really briefly. We're going to go over...
Hi, Vanessa's on as well. I just don't have visual.
Oh, so go ahead. All
right, no worries. Sorry, TSB, for interrupting. My name is Vanessa Willoughby. I use they, them pronouns. I work at BlackRock within our iShares business, our ETF indexing business. I work in institutional sales, largely with asset manager clients.
Thank you, Vanessa. We need them because I don't know if I can explain the asset management slide at the end. Anyway, so for the agenda for today, we're going to go over an introduction for financial institutions, kind of talk through the life cycle of a transaction that we have put together for it. And after that, we'll go through some questions. And I'm just going to kick it off here for generally what are financial institutions. And that's where you kind of come into the section of sell side versus the buy side. And I think that's where we should start. In terms of the sell side, it mostly consists of what you would think of for banks, advisory firms, and other firms that generally facilitate selling securities on behalf of clients. A lot of the roles that the sell side would kind of perform would be marketing and selling securities, advising corporate clients, facilitating the raising of capital, creating liquidity, for listed securities, and ultimately helping clients interact with the market in that way. The buy side, on the other hand, are often what you think of when you consider something like an asset management firm. You think of professionals and investors that have money or capital and ultimately buy securities and interact with the sell side oppositely. They are usually representing investors that will kind of be able to give them what they are using in terms of the investing, in terms of the portfolios, and they're managing that client's money. They make investment decisions, buy, hold, sell, risk-adjusted capital, perform in-house research, and a whole host of other items that are within that. And then with the slides, you can kind of see we have a couple examples up from our sponsors of what sell side and buy side looks like. And I think we can move on from there. So for the life cycle of a transaction we're going to walk you through today, we're using an example of a company called Outcorp, a 10-year-old company that specializes in design, manufacturing, and sale of LGBT-themed merchandise. And so after several record-breaking years, they've decided that they want to take what they are now, which is private, and go into a potential IPO offering, and they've decided to go public. And what we are walking through is what that actually looks like. How does that move from inside of something like a bank into inside of something like the buy side? And you begin on that with, generally when you're looking at, oops, how did my Zoom just do that? Oh my goodness. Okay, so the first thing that they're doing is ultimately trying to find underwriters or working with banks to advise on what that transaction is going to look like. And ultimately those banks and partners in lots of different financial capacities work with them in that capital issuance and kind of that first look of what the pricing is going to be on the market. It's a lot of structuring, it's a lot of legal advisory, and you know, ultimately they have to abide by a lot of different SEC regulations when you're going public. So there's a lot more rules to the game when you are going through an IPO and when you're a company going public. But ultimately in making that decision, what they are trying to access is more capital. So they're opening themselves up to a public market of investors that would be able to invest in them. And once they're on the market, you're going to get into something like secondary trading. So stocks that are already listed and how banks interact with clients in terms of either advising them with research. For example, I'm in a research capacity at RBC. So we work with our clients on the institutional side to have research written on specific companies or macro themes that are trading in the secondary market after the IPO. So that's a very general overview, and we'll move next. And I'm going to mute myself now.
Great. So I just want to cover for the group sort of within an investment bank, the different types of groups. And for all of the major banks in the US and even the boutiques, you often find both industry and coverage teams as well as product groups. Now, there's a couple of interesting distinctions between the two. Industry and coverage groups are those bankers that really are the primary points of contact for an investment bank's corporate clients. And their job is to maintain the relationships with the executives at those companies. So if you are a healthcare banker covering the biotechnology space, your job is to exclusively maintain relationships with those biotech clients. If you are a more junior person working in an industry or coverage team, your job is to focus exclusively on running analysis, modeling, doing strategic work for biotech issuers. And your job is to really know all of the ins and outs and all of the intricacies of the client base that you cover. On the other side of the page, the product groups, the goal or the function of the product groups is to really own the different products that exist within corporate finance. So you have equity capital markets, you have leveraged finance, you have high-grade debt capital markets, and then you have mergers and acquisitions. And each one of those businesses now represents such a significant part of a bank's business that they have dedicated teams that have become experts in those products. And so my job as an equity capital markets banker is really to know all of the ins and outs of the equity capital markets process. So if a company is going to come public via an IPO, my job is to advise them through that process, including timing, structuring, how to price a transaction, etc. So on the left-hand side of the page, we have industry and coverage folks who focus exclusively on one sector. On the right-hand side, you have product groups which focus specifically on a product. At some banks, product groups actually are segmented by sector. I only cover the healthcare sector. At other banks, product groups, if you're an analyst, associate, a VP, you will cover multiple sectors on your product team. Next page. Great. So this page, I just want to spend a minute here talking about how capital is raised sort of within, or the capital raising life cycle. And I play a very interesting role in this. And the interesting part of a group like equity capital markets or debt capital markets is that you act as the liaison between your corporate clients who are trying to access capital and the buy side or investors who are providers of capital. And I partner with a group at my bank called the syndicate team. They assist us in all of the nitty-gritty details of pricing a transaction and allocating capital to investors. Big players in the capital raising process include our sales and trading teams. If I am working on a $25 billion IPO for a tech client and we want to go and see the team at Fidelity who covers tech names, I will call my sales guy in Boston who covers Fidelity and say, I need your help in securing a meeting with the portfolio manager at Fidelity who covers this tech name. And I want you to maintain the dialogue between now and when we price the IPO on how this person is feeling about making an investment in this company. So sales and trading also plays a key role in partnering with the capital markets teams and bringing capital in the door. Last but not least is the asset management team. I just referenced Fidelity as an example. Fidelity is one of the biggest portfolio managers, asset managers that exist within the United States and in the world, quite frankly. Within Fidelity, there are portfolio manager and analyst teams that cover different sectors. So there's a healthcare group, there's a technology group, there's an energy group. There's groups that cover every sector under the sun. And so it makes it easy for a capital markets team, like someone in ECM, when I am trying to raise money for a biotech company, I know exactly who to go to at Fidelity to talk about an investment decision. So hopefully that just provides everyone a really quick overview of sort of how the capital raising process works. Happy to take any questions at the end of the session.
Hi, so that was an incredible overview, Brad. Thank you so much for that. You mentioned a little bit about how sales and trading can interact with what we call the primary market, which is before these bonds and stocks hit the market. That's called primary side. My work focuses on the secondary side, which means that it is our job to determine the value of financial assets like stocks and bonds after they've been issued by the company. So the main way that we do that is by having a general broad knowledge of things that are economic drivers, whether it's policy in other countries, it's supply and demand, or general current events. And most recently, we can also talk about algorithmic trading and market making in that function. So for us, we don't necessarily have contact with the corporate clients, but it's our job to be experts in how the market is interpreting the risk on an asset. So in our world, we can specialize in helping Brad. For example, if we're a portfolio manager or a trader there, we may only trade assets that are considered biotechnology based. So I actually don't focus on that. I focus on foreign exchange, which means that my job is to determine the global risk that different issuances will face. For example, in the case of going back to biotechnology, I'm looking at the supply chain. I'm looking at how is COVID-19 impacting different currency pairs? How does Chinese-US trade policy impact this issuance? But I may never actually talk to the corporate. So it's a lot more of a macro role, and the risks are all macro-based as well. So we're there as advisors a lot of the times. I think next slide.
Hey, Vanessa, do we have you?
Yes, I believe I am on audio and video, albeit 2 disparate platforms. So I'm going to talk about the asset management side a little bit. So asset management, just broadly speaking, it's like you're managing assets on behalf of others. So think portfolio management. There's also a lot of different jobs within this bucket. So for instance, I work in sales. So one thing they have listed under institutional asset managers, kind of where I work in at BlackRock, we have clients who are pensions, foundations, endowments. That's the asset owner side. And then we also, within my business unit, iShares, we also work with other asset managers and sell products to them as well. So we'll sell based on kind of like, you know, they have this column up here for mandate. So you're kind of thinking like, what's someone's risk appetite? Are there any sector constraints? For instance, like you're able to invest in fixed income, but no high yield, for instance, and kind of like what's like the timeline for returns. So you kind of like take all of that and then kind of like combine that with the capabilities of like a risk analytics platform and a risk engine to kind of like understand, you know, like what kind of is the best like portfolio suggestion that you have for someone. I'd say within asset management, there are people who manage entire portfolios on behalf of entities. So then you also can manage like a slice, for instance. So if you think that there's someone managing a pension and they say, we kind of want a liquidity sleeve solution, so a slice of our portfolio that we're not actively managing. We're kind of happy with like an index product in this instance because we're constantly changing this allocation. We want to make sure we're using the PM's time most responsibly. Then they'll say, okay, like I'll allocate, you know, this slice of like 100 million than like, you know, a larger framework to index strategies. So there's a lot kind of under this broad umbrella. They have, you know, institutional asset managers, kind of more of the wealth side, private equity, and then hedge funds just really speaks to like a different structure. So you're not investing under, I guess, like a 40X structure. So there's a lot of things that you're managing on behalf of others. That's kind of like the gist of asset management broadly.
And last but not least, we did want to touch on the fact that while all of this cool stuff is going on out there, a huge part of financial firms, most of the people are not actually doing those types of transactions or monitoring the markets, or at least in that way. Yessi touched right on the money on what I do, and I wanted to focus on the 2 hats that I wear at Morgan Stanley, is give you an idea of some of the other areas that financial institutions are very active in. So I manage country risk for the bank, which essentially means we have to monitor the entire world. My joke is I have to have an opinion on every single news event, including the stock market. Whether it's worth anything, I don't know, but I still have a job, so that's good. But we function kind of like the intelligence agency, the internal intelligence agency for the firm. And we have a lot of things to say, both about the things that Yessi was mentioning about markets, but also about the kinds of risks in business that we think are appropriate for the firm. So it's a fun job. I've been to over 100 countries on behalf of the bank, and not traveling now, so I'm kind of happy about that. The other hat I wear is head of managing climate change risk, which is a newer risk for the banks, but a really, really important one. You can see from the way that our activities have been described that we play an essential role in allocating money and allocating capital across the global economy. And so, not surprisingly, everyone wants the banks to get on board with climate change, because how we direct capital for our clients is crucial for how this is going to evolve over the next few decades. So I'm spending a lot of time on that. We're very focused on that. We're very committed as an institution to making this work. And we thought it'd be fun as the last statement, just what's highlighted in green there. Yes, you can indeed work on climate change on Wall Street. It's exciting, it's fun, and maybe the most fun thing I do when I'm not traveling. I'll stop there and hand it back to you, Megan.
Thank you all so much for those overviews. And I think that I might hand it to Alan to direct some questions our way, if that is still the plan.
Yeah, so at this point, we have, it looks like, about 20 minutes for questions. Please put them in the chat box so that way, and please direct it also to specific panelists if you need to, so that way we can try to get some of your burning questions about financial services answered. But Megan, why don't you lob one at the panelists while we wait for questions to come in?
Yeah, for sure. I had a couple as a backup, also because it's just interesting to learn more about what other people do in different institutions and in your industry, because I am learning that every day. I think constant learning at a bank is definitely something I have gleaned from my role. So one question I would have for each of you, and maybe whoever wants to take it first could go ahead, is maybe what do you find to be the most challenging part of your job, maybe day to day or week to week? Just kind of what keeps you either up at night, or what is the most challenging role that you have during the middle of the day, and how do you tackle that?
I think it's a good question. I'll kick it off. I think the most challenging aspect of the job for me now is probably, as a VP, you sort of sit right in between your junior staff and your senior staff, and you are really beginning to ramp up conversations with real clients, like actual CEOs and CFOs, versus when you're an analyst and an associate, your clients are your VPs, EDs, and MDs. And so right now it's really trying to manage the blocking and tackling of all these different constituents, and really being an excellent communicator and ensuring that you're managing your analysts and associates time efficiently, you are managing upwards appropriately, you are managing your clients appropriately. But again, I would say that's evolved from when I was an analyst and an associate. The most challenging part of that job is just sort of keeping going and sort of day in, day out, and managing the workload. But I think what's really, really important for everyone who's on this call to understand is that I think if you find a role within finance that really interests you, hopefully you don't feel a burden of having to get up on a daily basis and oh, I'm going to work today. I work crazy hours right now, where everyone in finance is working crazy hours. It's I know everyone's busy all around, and I'm working a lot, but I get up every day and I'm just I love this. So taking your question, Megan, and turning it into a piece of advice, I would just say for everyone on the call, really try and pursue an area in finance that's really of interest to you, because then hopefully the day-to-day challenges that Megan asked me about don't necessarily feel too burdensome.
That's awesome. Okay, so we actually have some questions coming in, so I'm gonna just jump to the student ones. There's actually a couple for Clark and your work. Christine asked if you can tell us a little bit more about your work with climate change, and on that note, Gurveer also asked what opportunities there are to integrate concerns about climate change and sustainable finance in a more junior role, and where you see the future of sustainable finance going.
Great questions. So what we do at Morgan Stanley, and I'm sure it's the same at the other banks, is we look at climate change and managing it from two perspectives. One is, let's remember that financial institutions are profit-making organizations. And so it's always a bottom line question, which is how could we lose money because of climate change? And there are many ways we could, actually, from having buildings flooded because of rising sea levels where we have done the financing, to losing clients because they don't think we're far enough along on climate change. So that's part of it. We have to keep that in mind. But the other part is thinking about the opportunities. And again, this whole issue of mobilizing capital. What do our clients want to do and how can we help them? This is a very client-focused business. And what might surprise everybody on this call is we've discovered that more than 70% of the companies in the main global stock index, the MSCI, have already committed to transition to low carbon operations. I was surprised when I found that out. So we want to be there to help the clients. And those are opportunities for us to make money, of course, but maybe more importantly, opportunities for us to do the right thing in this. You know, climate change isn't only going to get bigger over time. And so I think there will be opportunities for junior staff. We operate this across the whole firm. We have people who are climate science specialists. We have people who come in with some experience from NGOs on climate. We have people like me who are traditional risk managers or bankers. And we'll need specialists in some of the high touch industries like energy or cement companies, you know, that use a lot of or produce a lot of emissions. So all of that sounds a little off-putting if you're entry level, but the point is, because we're looking for people with experience, but the point is there are a lot of entry points into working on climate, and it really runs the range across the whole firm.
Sorry, I was muted. Thank you so much, Clark. So we have a question from Mary for the panelists in general about what you all think the future outlook for alternative investments such as private equity and hedge funds. I don't know who would be best suited to take that.
Yeah, I'll just make a high level comment. I deal with both of those constituents with private equity companies who are looking to sell portfolio companies, and then with hedge funds on the buy side. The comment I would make is that you know, hedge funds have struggled over the last couple of years. Do I see there being a significant decrease in the asset class of the hedge fund asset class? Not really. I think they'll still, there will be enough hedge funds that produce strong returns to keep that asset class alive. Private equity continues to raise money at record levels. So both of those two constituents within corporate finance are here to stay.
Yeah, I would, just to echo a little bit about what Brad was saying in terms of the record level of financing. I used to work at a private equity fund. Like, our fund didn't close the deal for 2 years and we still managed to raise a $3 billion fund. So it's really wild. Okay, so we have some questions regarding ESG investing. So Patrick asked, when utilizing, Kungmin asked, I would like to know about your view about the future development of framework that we use for ESG investing, especially in light of controversies, recent controversies, specifically citing Boohoo. And then a follow-up question from Patrick regarding this is, when utilizing ESG data and pricing of securities, like, how do you all talk to clients about adopting the various standards that exist? So is there a super obvious pricing benefit to issuing, say, a green or social bond? And how do you navigate that conversation even?
Yeah, let me start off and then throw it back to you guys who are in the markets. But I think these are really crucial questions right now. ESG has just taken off like wildfire, excuse the climate pun. But this is the future. Companies, our clients, everybody wants to know, are we sustainable? How sustainable are we? What are our practices? What are our standards? But there's a really big problem, because there are no standards. There is no standard way to measure that everybody agrees on what is green, what is not, what is ESG friendly, what is not. And so the term greenwashing is out there. You probably know it. It's, you know, hiding behind a green label because there's nobody policing the markets. And I'd be interested in what my fellow panelists have heard about that or what you're seeing.
Yeah, I just just following up on Clark, just thinking about. Sorry. Okay, I'll go ahead. Just following up on like what Clark had mentioned, BlackRock, like regarding to ESG, like works with like MSCI to have like MSCI ESG ratings available for all of our iShares products now. So that's kind of like a new offering that we're working toward. We've also created a sustainable core lineup. So kind of taking like our heavily invested in like core offerings and then kind of create like an ESG optimized version of that. There are some limitations like when you're thinking of that because like not every single product has like an ESG rating that's relevant. So for example, I think like US Treasuries don't have like ESG metrics available. But I'd say definitely from a client inquiry point of view, I'm hearing a lot kind of like from the wealth side and the ETF strategist clients that I work with, there's a greater appetite and interest in ESG. And I'd say like regionally, I'd say a lot of the actual buying behavior is still happening in like Europe, but it's definitely coming up more increasingly like in conversations I'm having with like US based clients. Like if they're asking about factors, they're asking about ESG and they're asking also about kind of, you know, how do we examine like ESG risk within our like broader like analysis of like portfolio like risks. So I'd say it kind of comes in the conversation through like, yes, like a risk lens, but then also just from like client demand, they really want to see like what we're doing in the space.
And then I just might add on to Vanessa and Clark, just from a research perspective, at least, I think that, I mean, RBC, like a lot of other banks, has been taking a bigger stance on climate change, ESG, sustainable financing for the past number of years. And I think that in terms of build out of understanding in the space, there has to be a move towards ESG in research. So I think in the past year or so, we launched kind of a major ESG research platform with an analyst covering it and a big team covering it. And that is just either broad sustainability trends within the ESG world, but it also tries to break up a little bit of the E and the S and the G. And we've seen some clients in the traditional energy space, which is a lot of what I touch, because in global commodity strategy, we're kind of creating and forecasting macro prices for oil, natural gas, gold, regular commentary on geopolitics and such. But with such a focus on an energy transition, there's a lot of focus obviously on the E within ESG for some of the clientele that we've serviced. And we have seen major portfolio managers move from being traditional energy investors into primarily clean energy investors. And I think that ESG reporting and standards are going to be part and parcel to ESG research in major firms growing.
Awesome, thank you. So this question comes from Siddons, probably for all of you. How have you all approached moving between roles and locations in your career? And in your experience, has this been more planned or more pursuing opportunities that present themselves as they come up?
That question was about mobility?
Yes, correct. And how you've managed that.
Yeah, so I would say I'm a pretty unique case in that within investment banking, I've worked in coverage, I've worked in leveraged finance, and I've worked in equity capital markets. And there aren't many people who are at the VP level who can say that they've worked in all three of those groups, which are major groups within a bank. My first 3 years in coverage were largely a function of the fact that I grew up in Calgary, Canada, and I started my career there, and oil and gas coverage was really the only sort of career option available to me at the time. But I soon realized after working in coverage that wasn't necessarily what I wanted to do longer term, and that it was something more markets related, like equity capital markets or leveraged finance, that really piqued my interest. And so I went to my manager at the time and I said, listen, this is what I'd really like to do. I'm a strong performer and I want to stay at the firm and I want to help advance the goals of the firm, but I want to just do it in a different role. And they were very receptive to me doing that. So the earlier advice that I gave everyone, which was try and pursue something that really interests you, was advice I wish I had received earlier on in my career. But I'm also glad that I realized after only 3 years that being in a different group was something that I was interested in. Mobility is something that the banks will all try and facilitate. The only caveat to that is that you really do have to be a strong performer in your current role to make that mobility happen.
Cool. Thanks, Brad. Did anyone else on the panel want to share their kind of career trajectory and management?
I can speak.
Yeah, no, go ahead, Megan, and then I'll follow.
Well, I'll go quickly then, because I think I've only been in the role and in working full time for, I guess, 3.5 years now. And I think the takeaway that Brad just said, which is that I think firms these days particularly are really working to be able to let you be mobile is true, and that you do need to be a top performer in order to move along. I'll just say that I got my internship into a summer group, did really well in that internship, fell in love with RBC, but didn't really want to join back in a banking role. And so I accepted the full-time offer with an ask to be a rotating analyst, basically, and in markets. And when they put me there, I met Halima Croft, who runs our energy research team. She's this past CIA director. And I was just like, oh my gosh, how do I work for her? I studied energy in college and international affairs, and I felt like it was a better fit. So I leaned on HR and tried to get a rotation on that team when I was full-time. And that was switching business groups, which really wasn't heard of. So between markets and research, you didn't really do that once you were being paid for by markets, for example. And I'm not saying that that's a normal move around, but I would say that as long as you are showing that you have a true interest in the teams that you're working on within the firm you're at, I think they will work with you. But Clark, go ahead.
No, those are great comments. And I just want to emphasize, both you, Megan, and Brad said something really important, which is that you have to recognize and then kind of make your own opportunities. One of the great advantages of working in the financial world, and especially for larger financial institutions, is that there's such a range of functions and roles. And if you don't like what you start in, that's fine. You have the ability to move around. And I think that's a theme that I agree, the banks have become a lot more supportive of mobility, of finding the right place for you. And I think it's one of the real strengths of working in the industry. So yeah, both of you, that's what I love to hear, is people who can find their niche and really make it work for them.
Great. So we probably have time for one last question before we wrap up. But Mitch asked, how has financial service processes advanced digitally within the COVID era? And how do you see these processes going in the future?
I'm happy to kick that off. I'll give a really quick response. I would just say that JP Morgan in particular, we are investing huge amounts of capital into technology and making sort of our processes, especially within banking, just more efficient. But we are building new digital platforms, new apps. The amount of capital and time that's going into trying to make things more efficient is really, really, really interesting to see. But I would say that those things were being implemented pre-COVID.
Hey guys, it's Yessi. I think I can speak to this a little bit. So Deutsche Bank recently announced a partnership with Google to overhaul essentially all of our systems. And I think being on the trading side, you get a unique exposure to just how quickly the markets are automating themselves. like, for example, with our FX platforms, our clients trade from their phones, and they essentially, like, there's no reason to call us to trade. All of our trades are executed electronically. We manage our large portfolios and all of our risk via algos. And so just getting to be at the forefront of this technology is incredible to see. And specifically, I guess COVID has helped our clients realize that they need to automate more of their processes and more of their hedging processes. And it's exposed them to a lot of what we call, well, COVID is a black swan event. It's a tail risk. And so because of that, we've had to introduce new ways of measuring risks for our clients. For example, what is their value at risk? And how does that change now that the world has been through a pandemic? So not only is COVID forcing us to get our clients onto better platforms faster, but it's also making sure that we have the right risk metrics and are thinking about risk in a way that makes sense for our clients, especially when you're dealing with large corporations like tech companies that have global supply chains, or you're dealing with even just like your general like insurance firms who are now facing a new set of risk. So how do we best interpret the market to kind of make our clients aware of new risks, and how do we advise them? And of course, how do we trade off of it? So.
Great. I think that's a really great place to put a pin and wrap up this session at. So thank you all for coming here, for volunteering your time. Really appreciate you all being here today. And I'm sure the students are really appreciative of your time as well. Hopefully we'll be able to have more interactions throughout the rest of the conference weekend, but I do have all of our panelists' contact information on this screen. So, if you want, you can follow up, but thank you all again. And for the students, your next session will be starting at 1:50 p.m. Eastern Standard Time.